Investing. How to get started, where to do it, and how to manage risks and opportunities. Investing is one of the most powerful ways to build wealth and achieve financial freedom. However, for many, the world of investing can seem complex, intimidating, or even risky. In this article, I will guide you step by step on how to get started investing, which platforms to use, how to manage fears and risks, and what opportunities you can seize. We will speak in a practical way, without too many technicalities, to help you take the first step with confidence. Why invest? The power of compound interest. Before we get into the details, it's important to understand why investing is so powerful. The secret is in compound interest, or the ability to make your money grow over time by reinvesting your earnings. Albert Einstein called it the eighth wonder of the world. Let's take a practical example. If you invest $10,000 with an annual return of 7%, after 30 years you will have $76,123. If instead you invest $500 per month with the same return, after 30 years you will have $567,000. This is the power of investments. Even small sums, if invested consistently, can transform into large fortunes. How to get started with investing. The first steps. 1. Define your goals. First, ask yourself, why do you want to invest? Do you want to build a retirement fund? Do you want to buy a house? Do you want to achieve financial freedom? Having clear goals will help you choose the right strategy and stay motivated. 2. Create an emergency fund. Before investing, make sure you have an emergency fund that covers at least 3 to 6 months of expenses. This will protect you from unexpected events and prevent you from having to sell your investments at bad times. 3. Start with what you have. You don't have to be rich to invest. You can start with small amounts, like $100 a month. The important thing is to start and do it consistently. Where to invest? Popular platforms and apps. Here are some of the most popular platforms and apps to start investing. 1. eToro. What it offers: trading stocks, ETFs, cryptocurrencies, and copying other traders' investments. Pros: intuitive interface, ideal for beginners. Costs: low commissions, but watch out for currency conversion costs. 2. Robinhood. What it offers: trading stocks, ETFs, options, and cryptocurrencies. Pros: zero commissions, perfect for those who want to start with small amounts. Costs: no commissions, but earn on spread margins. 3. Vanguard. What it offers: index funds, ETFs, and mutual funds. Pros: very low costs, ideal for long-term investments. Costs: very low commissions, especially for ETFs. 4. Revolut. What it offers: trading stocks, cryptocurrencies, and precious metals. Pros: integration with a current account, easy to use. Costs: low commissions, but limited choice of assets. 5. DeGiro. What it offers: trading stocks, ETFs, bonds, and derivatives. Pros: fees among the lowest in Europe. Costs: very transparent cost structure. What to invest? Practical examples. Here are some investment tools suitable for beginners. 1. ETF, exchange-traded funds. What they are: funds that replicate the trend of an index, e.g. S&P 500. Advantages: diversification, low costs, simplicity. Example: an ETF on the S&P 500 allows you to invest in 500 of the largest American companies with a single tool. 2. Actions. What they are: shares owned by a company. Advantages: potential high yields. Example: buy actions of companies such as Apple, Amazon, or Tesla. 3. Cryptocurrencies. What they are: digital currencies such as Bitcoin, Ethereum. Advantages: high potential returns. Risks: high volatility, suitable only for those who have a high risk tolerance. 4. Common funds. What they are: funds managed by professionals who invest in an asset basket. Advantages: diversification and professional management. Risks: higher management costs than ETFs. Managing fears and risks. Investing is not without risks, but there are ways to manage them. 1. Diversify. Don't put all your eggs in one basket. Invest in multiple assets, stocks, ETFs, bonds, to reduce risk. 2. Invest for the long term. The market may be volatile in the short term, but historically it tends to grow in the long term. Stay invested even during crises. 3. Don't invest money you can't afford to lose. Only invest what you are willing to risk. Money for essential expenses, rent, bills, should never be invested. 4. Do your research. Before investing, be well informed about the asset or platform you are using. Don't blindly follow the advice of others. Opportunities to seize. 1. Invest in growth sectors. Sectors such as renewable energy, technology, and healthcare are growing rapidly. Investing in ETFs or stocks related to these sectors can offer excellent opportunities. 2. Cryptocurrencies. Despite the volatility, cryptocurrencies represent an interesting opportunity for those willing to take risks. 3. Emerging markets. Countries like India, Brazil, and China offer long-term growth opportunities, thanks to their expanding economies. Bottom line: get started today. Investing isn't just for the rich or the experts. With the right knowledge and a disciplined approach, anyone can start building wealth. Remember, the best time to start is today. The longer you wait, the less time you'll have to compound your money. If you want to learn more, I recommend reading The Intelligent Investor by Benjamin Graham. A Random Walk Down Wall Street by Burton Malkiel. The Psychology of Money by Morgan Housel.